Hi everyone, Ashley here. I just wanted to provide you all with an update on what's been happening in the investment world and what we've been doing here at DLP Life Design. So very quickly, general advice warning there on the screen. This doesn't take into account your personal circumstances or needs. So if you would like to discuss your situation with us, please do not hesitate to give us a call. So let's start with the Russia-Ukraine invasion and specifically what this means for markets. The sanctions that the West is imposing on Russia is only increasing the uncertainty of how Putin will respond. Those hardest hit will be the countries and companies with direct links to Russia. The economic effects, however, are much broader because Russia is a commodity superhouse, as highlighted in those dot points on the screen. Reducing or eliminating Russian supply from the global economy will have significant costs and create inflation risk. So while the risk of war initially weighed on the markets and the invasion has heightened volatility and caused a bit of a repricing in the markets, the biggest factor for markets to contend with over the medium term is the risk of stagflation. So stagflation is the combination of high inflation and slow growth, which is negative for share markets. We have been speaking with clients for the last 6 to 8 months about our concerns with inflation and interest rates. So to recap, inflation is the cost of living. If this goes up, people have less money to spend in the economy, so growth slows unless wages go up as well. If businesses are already paying more for supplies and seeing their profits diminish in this way though, it reduces the likelihood of wages going up as well. If in addition to this, interest rates are increased, which is what usually happens to control inflation, there's going to be more pressure on households to meet costs, especially those that are carrying debt. In the last 6 to 8 months, we've been positioning our portfolios to target shorter duration or shorter term fixed interest investments and bonds to reduce the likelihood of capital losses. Where there is speculation of an interest rate rise, bond yields tend to increase, which can devalue existing bonds that are paying a lower rate, and we find fixed rate home loans also go up. The bond market has started to increase yields, so the longer duration bonds that we have reduced exposure to, which have experienced up to 8% in capital losses. We'll continue with our shorter duration stance and monitor this moving forward. Our portfolios have also had a higher exposure to international equities. Moving forward, we plan to hold in this space and even underweight in this area and start favouring the Australian share market, given our market exposure to resources and commodities, which can be a buffer against. We are still very cautious and do not believe that a buying opportunity has presented itself for our clients who are sitting in cash. Current events have added a layer of complexity in an already challenged environment. So we're favouring higher cash reserves for a number of clients as we wait for more clarity and certainty on the future direction of inflation and economic growth. For our clients who are already invested, we are holding the course. We feel there is a storm coming and your portfolios are well positioned to weather this storm. Our long-standing pillars of investments still stand. So our investment philosophy is about these 4 core things: diversification, good quality investments, low cost, and liquidity. We will be keeping to this strategy over the long term. It's how we create and protect wealth for our clients. If you would like to discuss your portfolio in more detail, please do not hesitate to reach out. Thanks.